Okay, time for some Q&A. Every week I go through the comment section of the Market Outlook video and I just scroll through and I answer the questions. And I spend maybe as little as 5 seconds on a question to as much as 2 minutes on a question. And somebody pointed out that it's not very satisfying getting a very surfacey question or answer to 50 questions. Why not pick 4 or 5 questions and go really deep on those? That has more value. I agree. So that is what I'm going to do this week. I have four questions that really represent probably 15 to 20 of the questions in a very broad sense. So I'm just going to start picking 4 or 5 a week. Let me first address a video I put up with the title, Is MicroStrategy a Pyramid Scheme? Where I just questioned this whole idea of intelligent leverage. And I showed you a very simple example where there is no leverage. You can create this. Anybody can create this. It's just math that makes it look like there's leverage, but with convertible shares and share-based compensation. Keep in mind, MicroStrategy still produces a lot of share-based compensation every single year. It prints shares out of nowhere to give to management and staff. That has a dilution effect because there is nothing there other than the cost of it, and it is a very real cost. So let me the biggest confusion, and I'm just going to address the big confusion here, although I don't know what good it will serve. I was shocked at how many uninformed people there were in the comments section. And when I say shocked, I mean shocked to the point of you can't possibly believe this. And some of the comments showed such a level of misinformation. Now let me pull back on something. I say that the investors here must be stupid. Maybe that's harsh. Let's just take off the word stupid and say unintelligent. And you may think, well, hang on, stupid and unintelligent are the same thing. Well, no, they're not. Unintelligent simply just means a lack of intelligence. Intelligence means that I can tell you point A and I can tell you point B, and I don't need to tell you point C. If you know A and B, you can figure out C all on your own. You can connect the dots and say, well, if A and B are true, that must mean C. Somebody who's unintelligent cannot do that. They can't make the connection to C. I would have to tell them what C is. That doesn't mean they're stupid. It just means they're unintelligent. That's what intelligence is. Intelligence is the ability to see beyond what's given to you. Many people lack that ability. I'd say the intelligent in the population is roughly about 15%. The rest are unintelligent. But what shocked me was not just that, but the level of that they are misinformed by or uninformed by. And I'll give you one, and I'll just answer one, although, like I say, I don't know that it'll do any good. When we think about Bitcoin and we think about an asset, let's say a printing press, the confusion sometimes is, well, when a company buys a printing press, isn't that the same thing as buying Bitcoin? They're buying an asset, they're raising money, or they're getting debt to buy the asset. Isn't that the same thing? Isn't every business a pyramid scheme? The difference here is in the type of asset. This is called a financial asset. This is called an operational asset. An operational asset is used in the operation to produce some output. And that output then has value that then produces a cash flow. Right? So with the printing press, I can print books, I can sell books, I can make a margin on those books, and I can produce cash flow. And that is what the printing press is useful for. It's useful for, or it has value for its use of being in use. Bitcoin is a financial asset, which means I can't make anything with Bitcoin. I can't put Bitcoin in my shop and say, okay, give me output. Bitcoin has no yield at all, which means it does not pay me a coupon of which I can then reinvest and own more Bitcoin. If I own 1 Bitcoin at the beginning of the year and I go away at the end of the year, I own 1 Bitcoin. I don't own 1.1 Bitcoin. I don't have a 10% yield. I own 1 Bitcoin. That's a financial asset. And a financial asset, if you have a balance sheet that is predominantly financial assets, the market cap I shouldn't say the market cap, but the net asset value per share, the share value, the net asset value per share should be driven by the balance sheet, not by the income statement. This company over here would be driven by the income statement. Why? Because it's producing revenue minus a cost of goods sold. Owning this asset produces revenue. Owning this asset produces no revenue. Only changes in fair value, right? Only changes in fair value. So if this is what you have, then your share price should reflect the asset value. So let's say that I have a company, and we'll put assets and equity. Well, never mind liabilities for now. And I have an asset worth $10,000, and it's an asset that you can buy. Call it a Bitcoin. Let's say that Bitcoin is only $10,000. I buy 1 Bitcoin. And there's $10,000, and I sell 1 share. How much would you be willing to pay for that share? You should not be willing to pay more than $10,000 for a share, even if this is a corporation. You shouldn't be willing to pay more than $10,000. Why? Because you could just go and you could buy this yourself for $10,000. So you sell 1 share, you'd have equity of $10,000. In 1 share. What is your net asset value? Your net asset value is $10,000 per share. What if I sold 1,000 shares? What would you be willing to pay per share? You wouldn't pay any more than $10 a share. Why? Because if you bought all 1,000 shares, it would cost you $10,000. Well, you would own 1 Bitcoin at that point. You could buy it for $10,000. Would you ever pay $30,000, let's say it's $30 a share. Would you ever pay $30,000 for a corporation that owned a $10,000 asset? No, you wouldn't. Not if it were a financial asset, because this financial asset does nothing. It produces nothing. It has no yield. So you'd never pay more for it. But let's say that this was, instead of a Bitcoin, let's say that this was a printing press where you could print books. Well, then you probably might want to pay more than $10,000 for all of the shares of the company if this company had access to great authors, right? If it had access to great authors and a great distribution system, you would say the existence of this printing press can create a whole bunch of output which can be sold for more. I might be willing to pay more than the asset value. When it comes to a financial asset, it doesn't matter who owns it. It's still only worth that financial asset. You can go ahead and buy it. There seemed to be a lot of confusion about that very simple concept that every company is a pyramid scheme if this is the case. That is not true. Most companies have operating assets, which means you have to value the business as a going concern. What is it in the business of doing? If it's in the business of just owning a financial asset, well, then all I'm willing to pay for that company is the value of that financial asset. That was a big confusion. I'm not going to get into the leverage factor. There is no leverage. It is convertible debt. There is only a very small, narrow window, in which the shareholder is not affected. Outside of that narrow window, the shareholder is hurt if the price goes too high. The shareholder is hurt if the price goes down. And that's just considering the convertible debt. That's not considering the share-based compensation, which is all of the free shares that MicroStrategy Management gives itself every single year at your expense. So if your desire now is to put a comment under this video saying, oh, he doesn't get it, he doesn't get Bitcoin, I'm not talking about Bitcoin. Not once did I say anything about Bitcoin. If your comment is, oh, go ahead and short it then. I never said anything about shorting it. I didn't say it had to go down. I said it's a pyramid scheme. But pyramid schemes can make money. Just it's a pyramid scheme. You don't want to be the last one left holding the shares. That's the story. The price of MicroStrategy has two factors driving it right now. Factor number one is the price of Bitcoin. I will say that. If the price of Bitcoin goes up because MicroStrategy holds it, the price of MicroStrategy will probably go up as well. In fact, if MicroStrategy were to trade at its net asset value, it would have to go sideways while Bitcoin tripled. And if that happened, then you would have what you could have today, which is an ETF. You don't have to pray for Bitcoin to triple and MicroStrategy go sideways to get an ETF. You can get that today. So there's Bitcoin, and then the other thing I said, which I guess I can pull back on now, is the other driver of the stock price is stupidity. But it's not. It's uninformed people. I'm not even going to call them investors, just uninformed people. And if you want to find a critical mass of uninformed people, and you know this is true, it's in crypto. It's somehow these people are drawn to crypto because it's easy for them to believe that there's something there. That doesn't mean it's a short. You just have to understand what you're buying when you buy this stuff. You are not buying the fundamental value of the underlying asset. You're buying the level of misinformation, the gullibility of the people. Now, if you think, but there's a lot of gullible people and it's easy to misinform them, then you must be bullish on these assets. And your job when you buy them is to continue to spread the misinformation to these gullible people. They will drive the price of it up. I would not short MicroStrategy because I would be shorting, well, let's go back to the word I used originally, I would be shorting stupidity. And there is no shortage of stupidity, especially in the crypto space. But hopefully, well, again, my my hope is rather low here, but hopefully you will understand the difference between a financial asset and an operational asset. An operational asset can be priced off the income statement, which means you can look at a multiple of some type of earnings. A financial asset is priced off the balance sheet, which means you're pricing it based on net asset value. And MicroStrategy right now has got a net asset value that is embarrassing. You are basically paying more than triple for Bitcoin when you could just go buy it yourself. Some of the comments are saying, oh, what he's missing is if Bitcoin really goes up. Well, then buy Bitcoin. Just buy Bitcoin and you'll own 100% of whatever it is that you bought, not 1.9% of it, with more and more and more dilution. With the convertible debt, with the share issuance that they plan, $21 billion of share issuance, and with all of the free shares management wants to cut itself at your expense. At your expense. All right. 4 more questions. Next question. In 3 parts. 1, 2, 3. A little bit of reading first. Recently at a seminar on Position Your Portfolio for 2025, strategists and economists from various large asset managers, PIMCO, HSBC, etc. So good company. Consensus tended to be to avoid the long end of the U.S. curve, as most thought inflation will never go below the 2% target. That is a bold statement. Never go below. Some trends that supported this argument long-term are industrial structure, energy, transport, and urban transformations are all capital intensive. In addition, even traditionally capital light sectors like IT are now capital intensive. I'm going to push back on that second part. IT, not any more capital intensive than it's ever been before. Large data centers. The cost right now is in the GPU. You bring that GPU cost down to pre-AI frenzy periods, It is the same cost it's always been, all the way through the 2010s. This was really the scale up of the large data center. 2010, 11, 12, 13. That really, that almost defined the reach space for data centers. Really came into its own during that decade. No inflation. It's the GPUs. So while it will increase CapEx, that is not a generalized increase in the price level. That is a specific price increase for a product. That's not inflation. And as far as making GPUs, it's not as if there is a material shortage. There is an IP shortage. There really is one name in the game right now, and bully for NVIDIA for being that one name in the game. But as far as making the product, as far as driving up the price of the materials for the product, which would be inflationary, there is no materials shortage. There's just a product shortage. But it's not as if you and I are buying GPUs. It's for a specific use. So I got to push back on that. Geopolitics. Deglobalization means supply chain redundancies. Why? Why a supply chain redundancy and overinvestment? Why overinvestment? I'm not following that. If you're deglobalizing, I don't think deglobalization is really what you're going to see. I think shifting centers of production is probably what you'll see. I'm not sold on deglobalization. And it doesn't matter about services. Deglobalization really only matters about products. And it only really matters about products in which you have no domestic production. That is not a lot of the goods that are sold in the U.S. The trade deficit in the U.S. is only about $1 trillion, less than $1 trillion a year on GDP of almost $30 trillion. Even if you count all of the imports of goods, it doesn't amount to enough that would cause generalized inflation. So I'm not sure why deglobalization means supply chain redundancies, especially in services. The U.S. economy is 80% service based, 20% manufacturing or production based. I'm not getting the redundancies or the overinvestment on that. So I would have to push back on that and say, well, why do you think there'd be redundancies as opposed to just, well, I used to get my stuff here, now I'm going to get it there. It's not as if saying, well, I used to get my stuff here, now I got to get it from there, and just as a backup, I better get it from there. You see, that's a redundancy. I don't know why there'd be redundancies, and most suppliers usually have a tapered strategy where they do get their supplies from a major supplier and a minor as a backup. Demographics, baby boomer retirement will mean less production and more spending. This is a chart from Fred showing the civilian labor force from 2010 to now. Baby boomers hit 65 in 2010. If you think that they were born 1945, end of the war, to 1965 as the cohort, add 65, they'd be retiring from 2010 to 2030. And there is your labor force. Your labor force is increasing even in the face of these retirements. 10,000 a day on average in the U.S. are retiring. 10,000 a day, and your the labor force size is increasing. Keep in mind, the U.S. has a lot of legal immigration, right? Everyone's focused on illegal immigration. The U.S. does have a lot of legal immigration, along with a birth rate. So that population is growing. So even though you do have a lot of boomers retiring and in distribution mode, they tend to buy services more than they buy products, usually very low on the goods, more on the services. You do have an increasing labor force. So I don't know that I agree with point number one. Energy, yeah, there's going to be investment in energy assets and transport and urban transformations. I think this will be a lot slower than what we really think. It's going to be. So I'm not entirely sold on this. And now these are trends that could push demand higher than that in areas higher than they've been, let's say, in the last 10 years. But over the last 10 years, you've also had an increase in capacity worldwide, an increase in technology worldwide. And even if you do have in the US an increase in energy, transport, and urban transformation, you have a decrease in China in the property sector, which was a big driver over the last 15 years of demand for commodities. So that falls off and something else increases. It's just a shift. Instead of Australia sending all of their iron ore and copper to China, they now send it to the US perhaps. Always the other side of the story is missing. The other side of the story is over the last 15 years, the globe has added a lot of capacity. If there is a tariff war with China, and China is probably not going to do very well during that, and growth is getting harder to come by in China without some significant spending, and they're already pretty tied up, that a drop in activity in China, a drop in activity in Mexico, if we believe all these tariffs are going to happen, a drop in activity is going to free up resources. If we believe that Elon Musk is going to squeeze efficiency out of the government, that is going to free up resources to be used in other places. If costs are beginning to rise, companies do rationalize, they do lay off staff. Look at GM. GM has decided, okay, 1,000 white-collar workers, so we can do without you. If AI is making these big strides, if IT is becoming more capital intensive, well, then there's got to be some output because of that output being increased productivity in other places. What is missing here is the pace of technology, the pace of entrepreneurship, the level of productivity increasing in stride with investments in IT. It can be convincing when you tell one side of the story, but you have to tell the other side of the story as well. Most agreed that deficit spending by the administration will counteract any easing by the Fed. I think you mean exacerbate, not counteract. Deficit spending, if we talk broadly, would be inflationary. Easing by the Fed would also be inflationary, so this would exacerbate, unless you meant deficit spending would counteract any tightening by the Fed. Keep in mind, if you get rid of deficit spending, every dollar a government spends in expenses is a dollar of somebody else's revenue. And this is part of national income. And there is an identity. Gross national income equals gross domestic product. It equals GDP. Gross national income equals output. That if you lower gross national income, you lower gross domestic product, you take inflationary pressure away. So Trump wants to cancel the $7,500 tax credit on EVs. Well, that is part of the deficit because the consumer spends $7,500 less. The government sends a $7,500 check to GM or to Tesla. Here's your $7,500. Well, Tesla has $7,500 in revenue that it claims, plus the lower price of the vehicle that it sold. So it gets the full price of the vehicle. The consumer then has $7,500 to spend somewhere else. By canceling this, the consumer now has to spend the $7,500 themselves. They may choose not to. If they do, Tesla still gets the same amount of money, but the consumer has $7,500 less to spend somewhere else. You take it out of the system. And if you don't, if the government doesn't send that $7,500 to Tesla, haven't you just reduced some of the deficit? Which, if you reduce the deficit, isn't that contractionary fiscal policy? And isn't that disinflationary or deflationary? We keep pointing out, oh, the deficit's going to be inflationary, but we keep hearing, well, JFK wants to limit SNAP, which costs the government money. Trump wants to get rid of the EV tax credits, which costs the government money. So we're hearing all of these cuts that they want to do. Nobody wants to talk about it. So no, I'm not sold on this. Besides, some of the best calls, if you're a sell side person, running with the crowd is what you want to do. There's safety in the crowd. You want to run with the crowd. If you're on the buy side, your best calls are typically those that are made against consensus. If this is the growing consensus, if this guy's saying it and this guy's saying it and everybody agrees with it, who's left to do it? Who's left to ignore the long side of the curve? If they're telling all their clients and everybody to just stay away from it, who's left, right? Now's the time to go against consensus. I disagree with it because we're missing the other side of the argument. I can make a whole bunch of good points for the case of disinflation and deflation. So there is my answer for that one. This question has to do with the applied level. I put it in just because there seemed to be a lot of confusion on this. Just wanted to confirm on the new pricing structure, I currently have access to everything in the applied level. Then nothing I say from here on into eternity has anything to do with you. Nothing would have anything to do with you. So you're now saying by January 25, I would continue to have access to the content I have up until January 2025. Well, 26, but I would have to pay $25 a month. Not you. Starting January 2025, nope. For either new content, nope. Related position, nope. You are grandfathered in, right? You're grandfathered in, which means you paid one price. I'll just put P for price. And that's it. The deal was, when you bought, is that you paid one price and you got access with all new content. That whenever I add new content, you just get it. That's the deal. I'm not reneging on that deal. I'm not rewriting anybody's deal. Starting January 15th, when the pricing changes, let's say this is a timeline, and here's when the pricing changes. Anybody before that date, nothing applies to you. You continue to get everything I add to the applied level in perpetuity, without any recurring fee ever. Well, actually, let me take that back a bit. I shouldn't say ever, because there was one person that was looking to produce something for the applied level, but did not want to just include it for free. And I said, well, we can add it as an add-on, but it can't be part of the applied level. So there may be things that show up like that, but they would sit outside the applied level. They wouldn't be part of the applied level. Anybody who wants to develop something for the applied level, they have to understand that the existing customers get it for free. It's included in. As of January 15th, it's 1 year access with all new. Anything that I put in here, you get all the new content. Everything, including positions, including everything I put in for financial modeling. And you're going to get a real treat on Monday. I'm switching financial modeling. We did sell-side financial modeling for Costco. We're going to switch to buy-side, which is, I wouldn't say distinctly different, but a far different focus. This is about coverage, right? This is about stock picking. How do you pick stocks? And that is what we're going to do. We're going to show you how to do that with CapREIT. But we're going to switch from sell side to buy side. You get all that for 1 year. And then after that, whatever content is here, you get forever. If you want new content, then yes, there is a recurring fee of $25 a month, only for those who buy from January 15th onwards. But there has to be some sort of recurring revenue. Has to be something. I made it very small. I made it very, very small. So it has to shift to that. Not only that, I've added significant value to the applied level in the 3 years. This December is the 3rd year anniversary. I've added significant value to the applied level. And with the buy side analysis coming in, which is something most of you will probably never learn in your life. is buy-side analysis, is buy-side modeling. Because most of you will always will work for the sell side. The buy side is the more exciting and the more fun place to be, but it's also the more competitive place. Everybody wants to be there. Few are chosen. So you're going to see techniques and strategies for stock picking, and how do we cycle through hundreds of stocks a year, because that's what you got to do on the buy side. The sell side coverage, you'll do about 15 to 20, and you'll stay with them. Whereas here, you have to go through hundreds of stocks in a year and pick 15 to 20 that you're going to invest in. How do you get that done? That's what we're going to learn over here. So there's the structure. If you're in before January 15th, none of this applies to you. You can just say, you know what? Doesn't matter to me. I got one of those grandfathered in golden ticket subscriptions. I never pay anything ever, and you get everything in perpetuity. But you buy on January 15th or later, then yes, you get 1 year. You get the same thing everyone has for the year, and then after that, it's $25 a month if you want the newer content. If you can't find $25 of value a month, if you can't say, you know what, this is worth $6.25 a week. If you can't say that it's worth less than $1 a day, 90 cents, 90 cents a day. If you can't find 90 cents a day of value in this, then yeah, I agree. You shouldn't bother with the $25 recurring fee, but you'd never lose your access to what you have. Okay, I've spent too much time on this. Okay, this question I like because it's hard to answer in words. It's easier to draw a picture of what they're getting at. Goldman Sachs projects an annualized nominal total return of about 3% for the S&P 500 over the next decade. That is 3% annual, is what they're suggesting over the next decade. However, and this is the question writer who's putting their rebuttal up here, which is counter, by the way. All of this is counter to what we saw in the first question of inflation because of point number 1, number 2, number 3, which I pushed back on. I'm not going to push back on this. I tend to agree with everything you're saying here. However, industries are becoming increasingly efficient due to advancements in technology, a trend expected to accelerate. Well, I don't know where you're getting the assumption of acceleration, but okay, I'm with you on this. The efficiency should result in lower costs. Let's just say lower OPEX. And we'll leave CapEx out of it for now, but should result in lower operating costs, higher earnings, and ultimately greater profits, driving stronger growth. Well, if you have lower costs, remember, one company's expense is another company's revenue, right? So if you can drive costs out, that means you're driving revenues down for another company. So while any one company may have greater profits, on aggregate, my savings over here is your loss of revenue over here. On aggregate, you might not get increasing profits at the macro level, driving stronger growth, which means I don't know that I would conclude stronger growth at the macro level. These two perspectives, low market returns, rising inefficiency-driven growth, seem contradictory. Do you think Goldman Sachs is underestimating the potential impact of technology on efficiency? Nope. Let us look at the market. And over the long term, S&P has tended to, with dividends and reinvestment, do about 10 to 12%. So that is an expected return over the long term. But in the short term, it does all sorts of things, right? Like it kind of does this kind of thing over here. But in the long term, it tends to do that. So this is usually a point estimate, right? With a distribution. What they're saying is, if the market is priced in equilibrium. But what if the market is not priced in equilibrium? If the market is priced in equilibrium, you can say that this line is 1.1, let's say 11% to the power of 10 over the next 10 years, whatever the price of the market is. What if the market is overpriced? This might only be 1.03 to the power of 10 if the market is overpriced. So if the market were 16.8 times forward earnings, Goldman Sachs would say, yeah, this should hold because the market is in equilibrium. But what if the market gets excited and starts pricing in all of that future growth today, such that you are paying for that future growth today, such that the market is trading at 22 to 23 times forward earnings? And Goldman Sachs is saying, well, sometime over the next 10 years, the market will revert to equilibrium and will find its way back to the attractor point, because it does cycle in and around that attractor point. That is the case it's making right now, is that this forward multiple today, so much of the future is already priced in that by the time we return back to equilibrium, there really isn't that much of a gain over the long term if we assume the market returns to equilibrium. Equilibrium being whatever this multiple happens to be, and in equilibrium, the multiple is believed to be around 16.8 to 17. That's the argument. Now you can push back and say, where we are today, we may justify higher multiples because the S&P is more growthier. It is a mix of growth and value. And when you have 50-50, maybe that is an equilibrium multiple. But what if you have 70% growth, 30% value in the S&P 500? Wouldn't it justify a higher multiple? That is an argument you can make. Only time will tell whether that plays out or not, or whether the long-term forward multiple trend is still an attractor point. If it is, then that is Goldman Sachs' argument right there. It's based on that. Okay, is the long-term outlook for copper and gold miners still bullish? In my opinion, yes, on both. I am dollar cost averaging them for buy and hold 5 to 10 year horizon. Thesis should hold true since the supply is dropping, which is true, especially on gold, even if it's under short-term pressure from tariffs, China, USD. Someone will have to buy those commodities to produce the goods we buy, especially for copper and the AI digitalization story. Well, that's the big thing for copper. If you believe the world is electric and not internal combustion, never mind Trump's ending the EV mandate. If you think, okay, well, that's this 4 years. Wait till the Democrats win in 2028 or whatever you think. Or, well, what about the rest of the world, right? If you think the future is electric, if you think the future is going to be more digital than it is today, if you think the future is robotics and automation, all of that requires the moving around of electrons. And electrons require copper. So it would be bullish for copper. We know right now the time it takes to build a mine is 7 to 10 to 15 years, depending on where you're building it. Some countries no longer want copper mines. Panama has decided its largest copper mine. No, we don't want that in our country. That's off the market. 5% of the world's copper supply was off the market just that day. As far as gold goes, there are no more big finds, tier 1 mines. There are no more big tier 1 mines, and the yield, which is the grams per ton, has been dropping over time and is still dropping. So fast forward 5 years, there'll be less gold being mined. Now, if you think we're going into a more fractious world, a more politically anxious world, that Trump is not going to unite but may isolate the U.S. and raise political tensions by creating a stronger a stronger axis against the U.S., demand for gold will increase. If there's any question about U.S. debt and the sustainability of it, then there'll be a move away from the U.S. dollar. There is no other big reserve currency in the world. It would be gold. So, I find it odd that over the last little while there's this huge concern about geopolitical risk, this huge concern about U.S. debt and gold sold off $300 an ounce. I find that very odd. It's like, well, those two things are telling two different stories. So I still think that if you want to produce more gold, you have to raise the price, because mines have reserves and they have resources, right? And we know what reserves are. Reserves are commercially viable, right? Resources are geologically viable, but commercially not viable because the price is too low. You'd need to get the price higher. So if we think about it as a price chart like this, and here is the current price, you may have a level over here where there's your reserves and all this is resources. So the price would have to go up, and if the price went up to here, well, some of those resources become reserves. If you run out there, the price has got to go higher, so some of these resources now become reserves, etc., etc. I still think that continues on for gold. And for copper, again, if you believe the world is going to be more digital than it is now, you need electrons. If it's going to be more robotic than it is now, if it's going to be more autonomous than it is now, if it's going to, especially for transportation, be more electric, if you think that companies are going to be investing a lot more into AI, if you think cloud computing, cloud security, data centers are just going to continue to grow, you need copper and more and more and more copper. And if you think that utilities are going to have to dramatically increase their asset base, all of that requires more copper. There aren't enough mines in the world for the forecast of what it would be in 10 years unless you say to the EV space, okay, you guys got to pull back really, really hard. And if they don't, if the market pulls through that EV demand, yeah, there is not enough copper, there is not enough gold. That if you go out 10 years, sometime in the next 10 years, I think you could see copper more than $10 a pound from, what, $4.03, $4.04 now. And I think you could see gold more than $5,000 an ounce. I wouldn't even wait 10 years for that. I think you could see it more than $5,000 an ounce from what we at 2,600 right now. I don't even think you have to wait 10 years for that. 2045, 15,000, I think is in line. I don't think that is a ridiculous forecast for the price of gold. So yeah, I still have FCX. I still have Newmont. I think they'll be under pressure for a couple of months. I think they'll be under pressure until we see post January 20th, once Trump is sworn in, until we see exactly how he's going to run things, until we get more visibility instead of just, the crazy people he wants to appoint. Have you heard who he's appointing to head up Medicare and Medicaid? Have you heard this one? This was released today. Dr. Oz to head up Medicare and Medicaid. Dr. Oz. Dr. Oz. Everything it seems is coming off a TV somewhere, right? I think I don't really know what to think is going on right now. I don't know if he's floating out names just to see what the reaction is, saying, let me float out the most ridiculous names just to see what the reaction is. And every other name will be less ridiculous. If I get everyone used to these ridiculous names and then I pull back just a little, no one will say anything. Maybe he's just pushing the boundaries of believability and then pulls it back a bit so that everyone says, oh, okay, well, at least it's not Dr. Oz. At least it's not Matt Gaetz. Maybe that's what he's doing. Or maybe he truly is serious about turning over the U.S. government to people like this. Maybe he just wants people in place that will say yes, no matter what he says. Maybe he is within the perimeter of democracy setting up a dictatorship by getting everyone in place who will be loyal to Trump, not the Constitution, and will just say yes to everything he says. I don't know. That's why I think that these things will be under pressure for a little while until we exactly see what's going on. and see what the global game looks like in terms of tariffs, in terms of what needs to be done, in terms of the go forward path on automation, on robotics, on utility build out, on EVs. But long term, oh yes, I am still bullish.